In this lesson, we'll learn what happens when the parent acquires control over the subsidiary in multiple transactions. This is when the parent already has some ownership interest in the sub and then finally gains control when it buys enough to tip the scale over 50%. This is called a business combination achieved in stages, or step acquisitions for short. In this video, we'll focus on the acquisition that tips the scale, the transaction where parent finally owns more than 50% of the sub. At that point, we have to mark to market our existing investment before recording for the current acquisition. With that in mind, let's go to the board. Start by reading the question. What are they asking for? Prepare the journal entries to record the acquisition on January 2, year 2. Make a note on the top of your board. January 2, year 2, journal entries. Let's read the prompt. On January 2, year 1, PCO acquired 40% of the 10,000 outstanding shares of ESCO's common stock for $40,000. On December 31st, year 1, S reported net income of $100,000 and dividends of $8,000. P uses the equity method to account for its investments where it exercises significant influence. On January 2, year 2, P acquired an additional 5,000 shares of newly issued common stock of S for $24 per share. Its trading price on the NYSE. Prepare the journal entries to record the acquisition on January 2, year 2. That's a lot. Remember, just break it down sentence by sentence. Now, they're asking us for year 2 journal entries, but let's start with the journal entries from the beginning. Then it'll be easier to see where the year 2 numbers are coming from. Let's set up for January 2, year 1. P acquires 40% for $40,000. For FAR, remember, start with what's easy. Start with cash. P is acquiring. P is buying. When you buy something, you spend money. Cash decreasing, that's a credit. What's the other side? What are we getting? Investment in S, debit, $40,000. First sentence down, next. On December 31st, year 1, S reported net income of $100,000 and dividends of $8,000. P uses the equity method to account for its investments where it exercises significant influence. P uses the equity method. Let's do a quick review of the equity method. It's the beginning investment plus parents' percent of subs net income less parents' percent of subs dividends equals ending investment. Sounds familiar. Sounds like non-controlling interest. Beginning non-controlling interest plus non-controlling percent of subs net income less non-controlling percent of subs dividends equals ending non-controlling interest. Wait a minute, it sounds like retained earnings. Beginning retained earnings plus net income less dividends equals ending retained earnings. Make note, they are all the same basic formula. Back to the equity method. P has to record its share of S's net income. S's net income was $100,000 times P's 40% equals $40,000. This is the equity method. S's net income makes the investment account increase. The investment is an asset, asset increasing, that's a debit. What's the other side of the entry? It's just earnings in S. It's a revenue that goes into P's income statement. Revenue increasing, that's a credit, $40,000. Next, P has to record its share of S's dividends. S's dividend is $8,000 times P's 40% equals $3,200. It's a dividend. What do you get when your investment pays a dividend? Cash. Cash is an asset, it's increasing, that's a debit. What's the other side of the entry? Well, when we get a dividend from our investment, what does that affect? The investment. That's an asset. The minus sign tells us that it's decreasing. It's a credit, $3,200. Those are the journal entries for year 1. There's a lot that hits the investment account. Let's take stock of the investment account using a T account. At acquisition, P debited $40,000. When P recorded its percent of S's net income, it debited another $40,000. When P recorded its percent of S's dividends, it credited $3,200. Let's add it all up. 40,000 plus 40,000 minus 3,200 equals 76,800 debit. Now let's hit year 2. On January 2, year 2, P acquired an additional 5,000 shares of newly issued common stock of S for $24 per share, its trading price on the NYSE. Let's figure out P's new ownership percent first. P owns 4,000 of S's 10,000 outstanding shares. Now P acquires an additional 5,000 shares of newly issued stock. Let's add 5,000 to the 4,000 we already have. Together, that's 9,000 on top. Now for the bottom. S had 10,000 shares outstanding, but now S just newly issued 5,000 shares to P. That increases the denominator by 5,000. 10,000 shares plus 5,000 newly issued shares equals 15,000 total shares. 9,000 divided by 15,000 equals 60%. That makes this a business combination achieved in stages. Remember, business combination just means the transaction where a parent acquires control over the sub. It took P more than one acquisition to get more than 50% of S's common stock, to get control. That's why we call it a business combination achieved in stages, or step acquisition for short. That means we have to mark to market the existing investment before we record the business combination. To mark to market, first we have to figure out how much market is. Our existing investment is 4,000 shares. The stock price on the business combination date is $24 per share. That makes the fair value of our existing shares equal to 4,000 shares times $24 per share, 96,000. But according to our T account, P's 4,000 share investment is at 76,800 on our books. So we have to get it from 76,800 to 96,000. Let's calculate the difference. 96,000 minus 76,800 equals 19,200. We have to increase our current investment by 19,200 to mark to market. Investment is an asset and it's increasing. That's a debit, 19,200. What's the other side of the entry? Gain or loss. In this case, it's a credit, so it's a gain. Now let's stop and ask a question here. Why are we marking to market our original investment? Doesn't this go against the general principle of conservatism and not marking up assets? Yes, it does. But here, FASB says that gaining control is such an important event that the whole investment, what we already have and what we're currently acquiring, should all be valued at fair value. And if you think about it, it's true. P went from having just significant influence to control. Now P wins every single vote. That's a substantial change in power. It needs to be commemorated with a drink and with an adjustment to fair value. Now that we've marked to market, we can record the business combination. When P acquires the controlling interest. In FAR, we start with what's easy. We start with cash. P buying an additional 5,000 shares at $24 per share, that equals 120,000. That's how much P is paying. Cash getting spent, that's a credit. What's the other side of the entry? What's P getting in return for its payment? The 5,000 shares. That goes into the investment. Investment is an asset increasing. That's a debit, 120,000. And those are the entries to record the year 2 acquisition. Just to summarize, the key to these step acquisition transactions is to mark to market the existing investment before recording for the business combination. That's it. If the equity method calculations threw you off a bit in today's lesson, just take a few minutes and commit those calculations to memory. Remember the basic calculation. It's beginning investment plus parents' percentage of subs net income less parents' percentage of subs dividends equals ending investment. Next up, we're going to learn how to eliminate those equity method entries in consolidation. You want to be sure to get these points on the exam. So stay tuned. I'm Liz Cho with Test Prep in a Snap.